Hi, my name's Gina Buckles, and I'm one of the advisors at 401k Plan Professionals. Today, we're going to talk about mergers and acquisitions and their impact on your 401k retirement plan. A couple of things we're going to cover today are some determining factors in a merger and acquisition that we need to consider before we move forward. Also, the transition period. The IRS does grant you a transition period before you have to operate a little differently. And we'll also talk about the discrimination, coverage testing, and some protected benefits you want to keep in mind as well. I also want to remind you that at 401k Plan Professionals, we are an advisor team that focuses 100% of our time on qualified retirement plans. We do have a lot of experience with mergers and acquisitions, so we're always a resource available to you. In addition, we provide additional services as the advisor, fiduciary, and investment oversight. We act as a liaison between you and your provider, do a lot of plan design consulting, and of course, can help you with any mergers or acquisitions you may have as well. We're also very passionate about employee services. We provide a lot of education, new hire, ongoing group meetings, one-on-one consultations. We've got a lot of webinars like these for both plan sponsors and participants to really enhance education to you and your staff. So we'll start with some important considerations in a merger acquisition situation. One of the first questions I ask when somebody contacts me and says, "Hey, Gina, we just bought a company in Colorado. What do we do?" My first question is it a stock or an asset purchase? And I'll explain the differences between the two and why that's really important. And also, I like to ask about, of course, the terms of the business transaction agreement. We sometimes call that the buy-sell agreement. So that's really important too. Sometimes how benefits and 401k plans are going to be handled or treated, that's outlined in that buy-sell or that business transaction agreement. So let's first of all talk about the differences between a stock and an asset purchase. A stock purchase means that the buyer is buying the company lock, stock, and barrel. They're buying everything, and they're assuming responsibility for all of their benefits, including the 401k plan. So it's really, they're assuming all of the good, bad, and ugly, and they're responsible for the 401k plan. Typically, in a stock purchase, there is not a severance in employment for the employees. So employees have not terminated employment, therefore they do not have a distributable event from their 401k plan. Oftentimes in a stock purchase, two things happen. Either eventually the plans are merged together, or the two plans, or how many plans there might be multiple, more than two, they have to be combined for discrimination and coverage testing. So ultimately, that's going to probably what's going to happen. Either the plans will be merged or they just have to be combined for testing. But the important thing here for the employees, there's not a distributable event. So they can't get their money out of the plan. Of course, then there's an asset purchase. So sometimes the buyer just buys certain assets, the equipment, the building, maybe the employees, but they just are buying the assets of the company. And usually in this case, the seller is responsible for the 401k. Oftentimes in this asset purchase, sometimes that 401k is actually terminated. And the employees of the company that's being purchased have a distributable event. They have actually severed employment. They're no longer working for that company. The plan may ultimately be terminated, and they get to choose what they want to do with that money, with their 401k. It's just like if you leave employment with any employer, you have an option to take your money out or roll it to a new company's 401k. Oftentimes what we see happen is those employees, they will roll it to the buyer's 401k. They don't have to, though. They can, they can cash it out. They can roll it to an IRA, but oftentimes maybe through an education process, they may roll it to the new employer's 401k. So the important distinction there with that asset purchase is typically employees do have a severance of employment, and they have some choices on what to do with that 401k plan. So those are some important distinctions on, number one, who's responsible and what happens to the plan, and ultimately what happens to those employees. So let's talk about the transition period. Most employers are really relieved when I tell them they do have a transition period. And this allows the companies to maintain the separate 401k plans through the end of the year following the year of acquisition without having to combine them for coverage or discrimination testing. They don't have to merge them right away. I'll give you a quick example of that. If a company buys or acquires another company on June of 2022, their transition period would end at the end of 2023. So they've got some time to maintain these 401k plans as is. And again, during that time, they're probably deciding, what they need to do. Again, is it an asset purchase or a stock purchase? Are we going to merge these plans? So it does give you a little bit of time to look over your options. And I did want to mention the coverage test. So the coverage test, the IRS created this coverage test to make sure that 401k plans offer fair benefits to their entire cross-section of employees. So you can have multiple companies. Employers may own multiple companies. There may be multiple 401k plans, but the IRS wants to make sure that overall you're covering enough employees and you're giving everyone equitable retirement plan benefits. So that's really kind of the gist of that test. They don't want an employer to have one company that they don't want to cover, and that company holds 50% of their employees. That would probably not pass the coverage test. So that's an important test. And again, at the end of that transition period, you're going to either have to combine all of the plans for coverage testing, or ultimately just merge the plans together so you've got one plan and then do the coverage testing from there. So let's talk about protected benefits. This is also important, and that the idea behind this is if you're an employee and you've got a 401k plan and someone acquires that 401k plan, there's certain benefits that you can't take away from me. For instance, you can't make me be less vested. You can't change my retirement age or, restrict certain contributions that were already promised to me. You also have to retain, my same forms of distribution at retirement. So there's certain things that that are going to be protected. And this is particularly important when plans are being merged. That's a really important process. When plans are being merged, we want to look at benefits in both plans. And ultimately, what we usually do is we take the most advantageous benefits and amend the document accordingly. So, everyone not only retains the benefits, but in some cases, people actually might get enhanced benefits as well. So those are some things that you can't take away from people when plans are being merged. A few other considerations too when there's a merger and acquisition. Oftentimes the surviving plan may want to grant credit for service with the predecessor employer. This would be for eligibility or vesting purposes. This can be done whether it's an asset purchase or a stock purchase. The surviving plan may amend it and say, hey, if you work for ABC company, we're going to credit your service and you're that much more vested in our plan. So that's something that we see quite often. And again, it would just require a plan amendment, but also, but an important consideration. Also, when the plans are merged, you also want to take a look at the composition of your highly compensated employees versus your non-highly compensated employees. This may have a big impact on whether you're going to pass discrimination testing or not. Also, the surviving plan may want to file for an IRS determination letter if the merger results in some significant modifications. So if you're going to merge those plans and there's a lot of changes being made, you might want to consider filing an IRS determination letter. Also, there's a Form 5310A. Sometimes that's necessary before the assets can be merged. Again, if there's significant changes, there's certain exceptions that can get around the need for that 5310, but also something to consider. I know there's a lot of considerations when there are mergers and acquisitions. So we always encourage our clients, if you're thinking about buying a company or you think you might get acquired, let's have this conversation first. We'll talk about the differences between stock purchases and asset purchases, and just some considerations like this that we want you to know ahead of time. So again, it's a lot of things to consider. We are not, your tax or legal advisor, but again, we are very knowledgeable, and I think we can certainly point you in the right direction. Make sure you're asking the right questions ahead of time, and you've got a pretty good idea how this is going to impact your employees' retirement savings benefits. Hopefully, you can reach out to us if you have any questions. There is our phone number, our email addresses. We're always happy to be a resource to you, and I hope you found this information and this short presentation very helpful. Thank you.